Welcome everyone, it's class time. Today we're going to focus on the section 2 of the syllabus that deals with production and resource allocation. Now today we're going to look at the following objectives. We are going to define the term production. We're going to define the term productivity. Then we're going to differentiate between production and productivity, identify the factors of production, which you probably know those already from previous lessons, define the term cost of production, and identify the costs associated with production. Now let's dive into the lesson. Now, most of us would have an understanding of what it means when we hear the term production. Production, we are producing, we are making, we are manufacturing. All of those terminologies are synonymous with the word production. So, but by formal definition, production is looking at the process of combining various inputs in order to make something for consumption, something for your consumers. It can also be defined as the act of creating an output, a good or service, which has the final value to the final consumer. Now, we realize that most things will have to go through a process. What are these various inputs, which you know already? These inputs are referred to as your factors of production. Your factors of production, they are land, labor, capital, and entrepreneurship. So what you will find is that these factors are combined together to produce an output, to produce a good or a service. So we combine the factors of production into the production process in order to produce an output. So your land, your labor, your skilled workers, with your capital, which is your machinery, or the money that you use to invest, along with the entrepreneurial skills, that is a person now that take the risk to do this business, or they have the special capacity to put all of the other three factors of production into the production process in order to produce a good or service. So I'm sure you're familiar, but just to remind you that a good is something that is tangible. You can touch it, you can see it. So we realize that during the COVID period, lots of persons got creative in making their own fabric mask because some of us could not get the other mask, and for whatever reason, persons prefer, and they probably get a little bit fashionable with it. While a service is intangible, you can't touch it per se, but you experience it. So if you notice the picture there to the other side, that is a lady there getting her spa treatment. And wouldn't we want one of that right now, just to feel good and relaxed? She can't show you the tangible spa treatment, but she experienced it, the massage and the relaxation, and that's the hot stone treatment. Okay? So goods are tangible and services are intangible. Now let's look at the term productivity. Now, productivity is looking at how efficient we are using the inputs to produce the good or service. So by definition, it is a measure of output per unit of input. So it is looking at the output that is being produced by land, labor, or capital. It measures how efficiently production inputs, again, or factors of production, are being used in the economy to produce a given level of output. So if you have land capacity, you have a set amount of workers and your capital, you are expecting that if they are being efficiently being utilized, they are to produce a given level of output, and that is referred to as productivity. So let us just look quickly at the types of productivity. So you have labor productivity. Now, labor productivity measures output per unit of labor used, and it is calculated by looking at the quantity of output divided by the amount of labor or workers that will produce that level of output, and you will get your labor productivity. You have what is called your land productivity. So again, it's looking at the measure of output per unit of land used. So your land space, your factory space. So it's looking at your output divided by the quantity of land used. So whether it is your factory space or your farmland and the level of output, you can calculate your land productivity. Then you have what is called capital productivity. And again, it's measuring our output per unit of capital used, and it is calculated as your quantity of output divided by the quantity of capital used. So let's look at this example here. We have a small t-shirt factory in Portmore, employs 5 seamstresses, and there are 5 sewing machines. And at the end of the week, they are able to complete 30 shirts. What is the productivity of labor for that week? So productivity is going to be your quantity that has been produced, which is 30 t-shirts, divided by the amount of workers or laborers in that factory, 5. So 30 divided by 5 is 6 shirts per labor. And the 6 shirts there represents the labor productivity for that factory. They have 5 workers and they are producing on average 6 shirts per week. Good. So let us quickly look at what therefore is the distinction between production and productivity. Now, this is a very popular question on your exam paper. They like to ask this question: what is the distinction between production and productivity? Production, as we referred to before, is the act now of converting the inputs, the raw material, the factors of production into goods and services, while productivity now is measuring how rewarding the factors of production are in relation to producing a given level of output. So one is the mere act, the simple act of manufacturing or making the good, while productivity is looking at the level of output that is produced given the inputs that are being used in the production process. Now let us look at the term cost of production. And this is a term that sometimes if you listen to the news and you listen to the Manufacturing Association and so on, they will tell you, or you'll probably hear them describe that the cost of production in a country is high or a cost of production in a country is low. What do they mean by the cost of production? Now, the cost of production, by definition, is the sum of payments of factors of production used in the production of goods and services. So they are looking at how much it costs the company, the total cost that is incurred by a business when they are producing a specific good or service. So they take certain things into consideration. wages and salaries, if they are paying rent or mortgage for the premises that they are using, if they have equipment that they have to be renting to be a part of the production process, the light, all the utility, light, water, all of that, the taxes that they have to pay to the government, all of those are a part of the cost of producing a good or service. So, once again, by definition, the cost of production is looking at the total costs incurred by a business to produce a specific quantity of a product or service. All right? So they have to pay for these factors of production. The land they have to pay for, the capital they have to pay for, the labor they have to pay for, and all the other miscellaneous services they'll have to pay for. And all of that is incorporated in the cost of production. Now, in the production process, there are two terms, and as you do your reading in your text, you'll come across. That is the short run and the long run period. And what do we mean by that? The short run period is that period in which it's not possible to vary the amount of factors of production used in the production process, like your land space, right? It's not possible to do that. But in the long run, what you'll find is that you are able to vary the factors of production, right? So short run, not a lot of flexibility there. There are some fixed elements, but in the long run, there are variable elements. And just to recap, short term refers to that period of time where it is not possible to vary the amount of factors of production that are used in the production process. For example, your land space, probably your factory space at the time you're just starting up the business, it's fixed, right? Then you have the long run period, and usually the capacity of the firm increases over time. And so all the variables there all the inputs, are variable in the long run, all right? But that is for another time, and we will make reference to it again. Now, I want us to now go to the types of the cost of production. And the first one is referred to as fixed cost. And as the term suggests, these costs do not change. These are expenses that the business must cover whether or not they are producing anything at all. So if they produce 0, they have to pay those costs. If they produce 100 units of whatever they are producing, those costs remain. Can you think of any costs that a business must cover even if they are not producing? I hear you. So, for example, you have a restaurant business and it must pay its monthly rent regardless of the number of customers it serves. So if nothing is happening, they have to pay their rent. Other examples of fixed costs would include things such as your property taxes, your equipment leases, right? Some amount of salaries also may be fixed costs, or if you pay for security on the premises, you will have your security there. Whether or not you're in business, you still have your security there because you want to secure your property and your equipment. So for some business persons, even in this lockdown period, it wasn't a good feeling for them because there were some costs that they must pay whether or not they were in business. All right, if things like insurance, if it is required by law that you have insurance on your business, then you must pay your insurance premium, whether it's monthly or quarterly, or else you're going to be in trouble. What you will find, therefore, is that the curve on the diagram here, you have your cost curve here and your quantity. Your fixed cost curve is horizontal, right? So this level of cost must be covered even if your quantity is 0. You must cover those costs, and we already look at some of the examples. All right, so keep in mind your fixed cost is a horizontal curve. There is absolutely no change taking place there. All right, let's look at the other cost. You have now what is called your variable costs. And if you see in your textbook total variable costs or total fixed costs, it's the same thing. Now, your variable costs are costs that changes with the level of production. So, as your production volume increases, those costs also increases. All right, and opposite holds true that if your production decreases, then the cost also will decrease. Now, some of the examples of these variable costs includes sales commission. Now, sales commission, you know, works based on the amount of sales that you generate. If you don't generate any sales, there's no commission to collect. Your utility cost. So if you utilize a certain amount of electricity or water in your production, if it's increasing or decreasing, the cost will fluctuate likewise. Same as with your raw material and some direct labor cost. Now, some workers are on contract, so you will only call them in when you have a peak season, like some bakeries. Now that it's coming on to the Christmas time, they increase their capacity in terms of making Christmas cakes and all these things, or if it's Easter time, and they will call in additional workers. So their labor costs will fluctuate at that time of the year. Now, what you will find is that your variable cost curve is now an upward sloping curve. So here on the diagram, you have your cost and your units of production, and your variable cost curve, if you notice, it's upward sloping. So as you increase your levels of production, the cost associated with it will also rise. So as you increase your production, your variable costs will rise. So you notice it's an upward sloping curve. This also signifies that there is a positive or a direct relationship between the level of production and the cost associated with producing that level of output. Now let's look at total costs. And from you hear the term, you know what it means. It's now looking at all of the costs. So what you'll find is that your total cost includes both your variable costs and your fixed costs, right? When taking into account all the costs now in the production process or when you're offering a service. So what you will find now in terms of your diagram, look at this closely. If you look at this diagram, your fixed cost is here at $40,000 or $40,000. That's the cost for the firm. Your variable cost, okay, it's upward sloping, all right? However, your total cost is both your fixed cost and your variable cost. And so your total cost will not start at zero because there's a fixed element to the cost. And so your total cost curve will start at the fixed cost, and of course, it's upward sloping because of the impact of the variable costs. So the difference between your fixed cost curve and your variable cost curve is as a result of your variable cost curve. All right? So let's take that slowly again. You have your fixed cost, which is $40,000. That level of cost it must be paid by the firm, whether there is production, yes or no. And you have your variable costs that's associated with the level of output. Now, your total cost is your fixed cost plus your variable cost. So your total cost curve will not start at zero with the variable cost because it has the fixed element. So it will start at your fixed cost curve and upward sloping to take into consideration the variable costs associated with total cost. So, just for you, a few formulas that you must know them by heart. They will come in very handy when you're doing your exam. Your total cost is your fixed cost plus your variable cost. And I hope you are at home making additional notes. If you didn't have it before, jot them down quickly. Your variable cost is your total cost minus your fixed cost, because remember that your total cost, includes variables. So if you want to know what your variable cost is, it's your total cost minus your fixed cost. And your fixed cost, we transpose the formula now, is your total cost minus your variable cost. So if you come across a question that they probably ask you to work the formula and to find the cost, you have it there. Now, let's try a quick question. You have your output from 0 to 5, and your fixed cost right throughout is $100, and your variable cost is right there. And they're asking you to complete this table and calculate the total cost at each level of output. And what did we say a while ago was your total cost? Your total cost is your fixed cost plus your variable cost. So all we're going to do for this simple table is add your fixed cost to your variable cost. And you can do this in less than a minute. It says 100 plus 0, 100 plus 20, 100 plus 27, 100 plus 32, 100 plus 45, and 100 plus 50, and you will have your total cost. All right, and the answer is right there. So match it quickly with what you have. I'm sure that you got it correct. So your total cost is your fixed cost plus your variable cost. Good. Now let's continue by looking at other types of cost of production. We have what is called our average total cost. And your average total cost is simple, the cost per unit of output, right? So you're looking now at your total cost divided by your output. So the formula here, please jot them down. Have a little formula sheet somewhere in your notebook. Your average total cost is equal to your total cost divided by your output. And if you look on the diagram here, and this is for another lesson, but just make note that the average total cost curve is a U-shaped curve. Just make note. It's another lesson, but just keep in mind the shape of the curves. All right? Let's move on to another cost of production, and this one is referred to as your average fixed cost. And your average fixed cost, it's now your fixed cost divided by output. I hope you're jotting all these formulas down on a nice sheet somewhere in your notebook. You can always refer to them when you're going back through past paper questions. Now your fixed cost being divided by an increase in output, what will happen is that your average fixed cost will fall. So it will continue to slope downwards, but it will never go down to 0. And we're going to look at the curve. So it slopes right down, but it will never go down to 0. All right? So if you notice here on the diagram, your average fixed cost, your fixed cost being divided by an increasing number of output, it will continue to slope from left to right, but it will never go down to 0. It will just continue to slope downwards. Then we have what is called our average variable cost. Now your average variable cost is your total variable cost per unit of output, and you can calculate that by dividing your variable cost by the total level of output. So it is your total variable cost divided by output. And the last one in terms of types of cost of production is called your marginal cost. Now, your marginal cost is one of the most important costs when we're looking at cost of production. Look at the definition. The definition is saying that it is looking at the additional cost when it's the cost of producing, an additional unit of output. So what we are looking at here when we are calculating is the change in total cost divided by the change in quantity. Now, this one is one of the formulas that tend to give students a little trouble, and so we're going to just go through quickly as an exercise in a short while. But make note of this, that the marginal cost is your change in total cost divided by your change in quantity. And I'm sure persons may be associating me now with formulas for econ. I'm so sorry. It comes with the territory, and we're going to get through it. All right? So the curve for the marginal cost curve is the one that the students love to call the one that looks like a tick. And you are correct. It looks a hook shape, and it goes right through the lower points for the average total cost and the average variable cost. Now, for your reading assignment, I want you to look at the relationship of these curves. That's for a different lesson, but not for today. We're going to keep it simple today. Now, let's look at this question. Here, we have our output. We have our total costs. And you're asked to calculate your marginal costs and your average total costs. Students, just to keep yourself, make sure that you make no errors, I've always said to my students, write the formulas at the top of the page so you do not forget. If you have to sing it, if you have to DJ it, whatever it is, memorize your formula. So your marginal cost is the change in total cost divided by the change in output. Now, one of the things also, and here's a little tip again, for you not to make any errors when calculating the question, I suggest, this is my little tip for you, that you start from the bottom up. Sometimes when you start from the top, because of miscalculation, you realize when you reach at the bottom, you don't have a figure. You start to panic. Where did I go wrong? I've always said to my students, start in the opposite direction. So, marginal cost is the change in total cost. So the change here is going to be 600 minus 490. So you calculate that change divided by the change in output, and that is 5 minus 4, which is 1. Lucky for us, all the output there, the change here is 1, so we don't have to bother ourselves too much about it, but just to make sure that we are calculating the total cost, the change in total cost correctly. I've worked it out for you quickly. So the change here is 600 minus 490, you get 110 because it's divided by 1. Then you go 490 minus 320, that will give you 170 because it's again divided by 1. Then it is the change again in total cost. It's 320 minus 270, that will give us the 50. And then 250 minus 150 give us 120. And for here, marginal cost, you will not put a 0, just put a little stroke there because we don't have any change from 1 to 0. That information was not given. Again, a tip for you, because sometimes you start here and you made the error in going 270 minus 50 and you put the 120 here. If you do that, you have nothing down here. So that is my little tip for students. Start from the bottom up. You can't go wrong if you do it that way. All right? So your average total cost. What's the formula again? Your formula is your total cost, this column, divided by output. Do not make the mistake and divide it by the change in output. It's not the change in output this time. That's a common mistake again. So it is going to be your 150 divided by 1. It is your 270 divided by 2, which gives you 135. It is your 320 divided by 3, 106.67. 490 divided by 4 will give you 42.5, and 600 divided by 5 to give you 120. All right? So there you have it, students. Do not make any mistakes. Put the formulas all the time beside your tables so that you pick up the correct figures. So again, by way of formula, your marginal cost is looking at your change in total cost divided by the change in output, while your average total cost, it's your total cost column divided by the number of output. Woo, that's a lot. But with practice, you'll get through it. So let us look at, by way of recap, our main points. So today we look at production and what production is. It's simply the converting of the factors of production or our raw material into a good or service, something that is useful to the final consumer, right? So whether you're making masks, whether you're making pies, whether you're making shoes, clothing, we utilize the factors of production to do that. Productivity is measuring how rewarding or how worthwhile combining those factors of production, using them to make a certain level of output. So that shows the difference now between what production is, the simple making, and the efficient production or utilization of the factors of production to produce a good or service. Today, we just quickly look at our factors of production, which you have looked at in previous lessons. And just by way of reminder, these factors are land, labor, capital, and entrepreneurial skills. We looked at the cost of production, what it takes to produce, the payments that the firm or the business must incur in order to produce a good or service. We looked at the types of these costs of production. We looked at fixed costs, those costs that will remain the same whether or not we are in production. Whether or not you produce, you must pay them. Whether it's your taxes, your rent, your mortgage, your insurance, security, you must pay those. We looked at variable costs. The cost now that varies, as the word suggests, with the level of production. So if your production increase, you're using more light and water, you're going to see those costs increased also. We looked at total costs. Total costs, now, total costs includes both your fixed costs and your variable costs, a combination of both to give you your total costs. Your average total costs. Your average total cost is your total cost now divided by your level of output, while your average variable cost is your variable cost divided by your output. And the one that you must never make a mistake with is your marginal cost. Your marginal cost is looking at the additional cost incurred from producing an additional unit of output. And so your marginal cost is calculated as the change in total costs divided by the change in output. So please, students, memorize your formulas. Change in total costs divided by the change in quantity. And just to remind you, again, that little trick in the trade, when you're calculating your marginal cost, start from the end, go straight up. You will not make an error if you do it that way. So again, we say it's going to be the change here divided by the change here. The change in total cost divided by the change in output.